Are you interested in trying out the BRRRR strategy on a multifamily property?
Today we're going to break down one of the most critical pieces of the puzzle, ARV, after rehab value.
If you haven't already, click the subscribe button below and ring the bell so that you get notified every week when we drop a new video.
One of the biggest mistakes that new multifamily real estate investors make when they're getting started using the BRRRR strategy is not accurately calculating what the after rehab value is. Now, the BRRRR strategy is one of the most popular strategies there is in rental property. We want to teach you how to do it with multifamily, where you come in, you buy something that's a fixer-upper, you renovate it, you rent it out, and then you refinance it, allowing you to pull out some of the capital and then use it again.
Today, we're gonna talk about ARV and what it is, how to use it in the BRRRR strategy, how to calculate it, and all the good things. So ARV, after rehab value, what is it? Well, it represents the value of the property after you have rehabbed it or added value to it. But why is that important?
All right, so ARV is so important when you're doing the BRRRR strategy because the whole big thing about the BRRRR strategy is that refinance at the very end. And what's so exciting about the refinance is it allows you to do the golden goose where you have a pot of capital, you put it into a deal, you do all the things, you manage the contractors, get the property manager to, get tenants in there, you get it cash flowing, and then you refinance. And if you do it right, when you refinance, you can oftentimes pull some of your capital back out. So ARV is important because when a bank is going to make you a loan, they're going to make you a loan based on a certain loan to value. 70 to 75% is pretty much what we mostly see, right? That's most common. Well, if your ARV is lower than what you originally thought, when you go to refinance the property, they're only going to give you credit for the property being worth this much when maybe you projected it to be this much because you just simply didn't know how to do it. And that's why we're very passionate about teaching you how to accurately do it, because really for the BRRRR strategy, it is the end all be all to make sure that you really can pull out some of your capital so you can go do another one.
Yeah, because literally think about if you calculate it the wrong way and you expect to pull out more than you can when the time comes, that's a big bummer. Like, we don't want that for you. So,
boo.
Yeah, we don't want that. That's a bad strategy. So we want to make sure you have all the tools that you need to make this right. So if you like what you see so far in this video, make sure you click the like button below. So most people think of single family homes when it comes to doing the BRRRR.
Yeah.
Right? Why do you like the multifamily strategy for BRRRR? I know why I do.
Right, like we've been doing this for a long time, right? We've always focused on multifamily with doing the BRRRR strategy. Part of the big reason, even though I know most people out there, they use a single family home for that, is at the end of the day, cash flow is king, right? Cash flow is the thing that is going to allow you to create financial freedom. Well, single family homes, they're great for appreciation and for holding value, but they're not ideal for cash flow. Like you have to have someone who just stays for kind of forever. Otherwise, 1 month of them moving out will probably wipe out your entire cash flow for a whole year. So I just really like multifamily because it allows you to still do that same strategy where you buy it low, you fix it up, you raise the value of it through doing that. But then you have 2 tenants or 3 or 4, anywhere from 2 to 4 units, you have those rents now coming in, which gave you equity, which that was kind of the whole point of doing it for the single family was the equity, but now you have equity and cash flow. And that's a game changer. That's the millionaire maker. And we have a bunch of students that's literally all they do is the BRRRR strategy, and they are just chunking up their net worth every month by doing another and another and another. And the multifamily allows them to also have cash flow, which is awesome.
Yeah, so if you're struggling with how to calculate ARV and you have questions, you need clarity, comment below so that we can help you, okay? Okay, so let's break down all of the components, all of those single components that actually drive the ARV, right?
Yeah, so ARV, it's a tricky little bugger, right? It's not the easiest thing to figure out. But let me give you some parameters and take notes on this because there's certain things that you want to make sure you're looking for when you're looking at other properties. So in the 2 to 4 family, multifamily world, the value of a property is based on something that we call comps. Well, comps is short for comparable sales. So what that means is we're looking for other properties that have sold that are similar to ours. So I want to give you very specific things to look for so that you can start feeling empowered to get out there and start figuring out your ARVs.
Okay, so let's just say you've got comps, you're looking at them. How do I know it's a good comp based on the property I'm looking at?
Okay, so here we go. So there's a handful of different things you got to look at, right? Time frame is one. Like if we're looking at a property that sold 10 years ago, I mean, come on, really. Right. That's not comparable at all. So we want to have a short time frame, ideally 6 months. But here's the reality. I'm gonna tell you what you want it to be, and I'm also gonna tell you operationally how it actually is in the real world when you're trying to do this, which sometimes is a little different, right, than theory. So time frame, ideally 6 months, but there's not a lot of multifamily that sell as quickly as houses do. So there's not a lot of comparable sales. So sometimes, even though we ideally wanna look at 6 months, we might have to go further out. We might have to go back 12 months, maybe 18 months if there's not a lot of sales in the area. And frankly, that's what an appraiser is going to do.
So we're looking for properties sold within 6 to 18 months, depending. 6 months ideally, we'll go as far out as 18 months. And then that is the type that we'll look at from timelines, right?
Yeah, that's exactly, that's the timeline we're going to look at.
Okay, so let's say I found all of the solds within the last 6 months, 12 months, 18 months. And now what? Now, like, does square footage matter? Does the distance from the subject property matter? Like, what are all the factors?
Yeah, no, none of those things matter. I'm just kidding. They totally matter. Okay. Okay, so the first thing you want to look at is distance from the property. So just think about the house that you live in. If the house just down the block sold for X dollars and your house was the same size and the same bedrooms, bathrooms, and it was in the same neighborhood, well, that's a pretty good comparable sale as long as the condition was similar, right? But if there's a house that's 7 miles away, I mean, totally different area, right? Mm-hmm. So we like to look between, ideally within a half mile. Again, same as the first example, sometimes there's not a lot of comps, so sometimes you gotta look a little bit further out. So you start with the half mile radius around the subject property. Subject property means the property that you're looking at buying, and you look at what sold, all right? And so if you have to go further out than a half mile, then you go to a mile, and you have to go further out, then you might go 1.5 miles. Ideally, you're always going to have a higher likelihood of being in the same neighborhood when you stay as close as you can. But like the one thing you want to make sure that you aren't like deviating from is if you've crossed over like a freeway.
Oh yes.
Yeah, like
or any major dividing freeway, road, highway, something that says, yes, this is this side of the railroad tracks and this is this side of the railroad tracks, right? You want to make sure you know.
Yeah, and even if it's only a 1/4 mile away, but it's on the other side of a 4-lane highway that has a ton of commercial on it, those are typically dividing lines, and that's where values change. So no matter what the distance is, you don't want to go on the other side of a major anything that's a separator of areas. Okay, so but you can go further out if you're not crossing anything major. So just know that you'd have some flexibility there.
What about square footage? Does it matter if mine's 150 square feet smaller than the other one?
So it kind of depends, right? So it depends on what size it is to begin with. So let's just say we're looking at a triplex that's 3,000 square feet, right? So it's about 1,000 square feet per unit. If there's another one that's only 2,850 square feet, that's 150 square feet difference, absolutely, like that's totally fine. But we ideally want to land within 10% either way. So if it's 3,000 square feet, then ideally you're looking for something between like 2,700 and 3,300. We typically still have the issue of not having so many comps that we can be that picky. So sometimes you might have to deviate a little bit and look at not just square footage, but square footage maybe per unit. You sometimes will have to look at, let's say you're evaluating a triplex, you might have to look at some duplexes and some fourplexes and look at what those square footages are and maybe some price per unit. Jen and I do not look heavily at price per unit because when it comes down to actually selling something, it rarely holds. But with multifamily, if you don't have the ability to just find something that's similar in size, then sometimes you're gonna do a little bit of adjusting to try to figure out like how would an appraiser look at the value of this property? Because it doesn't matter how much a homeowner is gonna look at the value of the property, you're not selling it, right? We're in a long-term buy and hold security creating game, right? So we really wanna know what is the appraiser gonna think. And that's one thing they're gonna do. They're gonna look at other properties. If they can't find something perfectly similar, they're gonna look at other properties, do a little bit of cost per square foot, and maybe apply that. So that's something I'd say apply kind of on the last part of it, but if you have no other way to find something that's similar in size, that's really the way I would go.
And last but not least, you want to make sure that the bedroom bathroom mix is comparable. So if I'm looking at a fourplex that has 2-1 in it, I don't want to compare it to a fourplex that has 2-2 or 3-2.
People are willing to pay more for that second bathroom. Like, I know I am. I'm like, oh yeah, give me that second bathroom.
You got to take that into consideration. The bedroom bathroom mix has to be comparable. So here's the next best question is, okay, Jen, Stacy, thank you so much, but where in the heck do I get comparables? Where do I get the comps?
Yeah, that's a good question.
Right? Realtors. So your realtors, as you're reaching out into your markets and you're getting those deals flowing into you, they should be sending you the deals with the comps.
Yeah, and I know that, does that sound crazy, right? How many real estate investing trainers are gonna tell you, go work with realtors? Well, we're the exact opposite of most people out there. We have had so many deals from realtors, so have our students, and they are the best source. For whatever reason, you don't have a realtor or your realtor's not available, they're not getting you the comps, there is another way to get comps, and you can go to Redfin. And Redfin has all of the properties that have sold. So you have to get into their parameters and put in, like, you know, the area you want to look at, the type of property you want to look at, and just see what else has sold. So ideally you're getting it from your realtor, so that you don't have to go spend the time on Redfin. But if for some reason you don't have a realtor or you need to look for more comps, Redfin is a great source for that. And we've used that, we've taught our students to use that only if they can't get it from their realtor.
If you do want to get into multifamily real estate investing, but you're not sure what's the first step, the second, or the third, you can click the link in the description below and a member of our team will hop on the phone with you and talk about your goals, your resources, and how we can hold your hand and get you to where you want to be.
The other thing we want to tell you is that we have a free Facebook group. It's called Multifamily Real Estate Investing. So if you want to be around people that are like you, on the journey, looking to learn, come join us in that Facebook group. We do tons of free education and content there. And every week, Jen and I make ourselves available for a question and answer session. It's live, it's in Zoom, we're face to face. You gotta come to the Facebook group, register, go to events, and then we'll see you there. But any questions you have about real estate, we're there to answer them for you.
And if you want to learn more from us, watch our next video on how much does a fourplex make. We'll see you guys next week.